Take a look at the last 3 weeks, 3 straight weeks of losses for the S&P 500. We haven't seen that in quite a while. And with that in mind, heading into, again, the busiest week of earnings this season, how high are the stakes?
You've got a lot of stuff going on, right? Like, you've got a little bit of a conundrum because you've had rates going up quite a bit. And I think that's been the large driver of this pullback that we've had. And pullbacks are really natural. Like, we can't forget that. If you look back over the last 50 years, the average intra-year drop is 10%, despite the fact that 37 out of those 50 years, the markets were higher. So, we just have to be used to things like this. But rates have been moving up. I mean, 10-year was up 12 bips last week. 2-year is up 9 basis points last week. So, and expectations for rate hikes, or I should say rate cuts this year. I don't think we're going to have rate hikes. Rate cuts this year have come down quite a bit. And that requires an adjustment of expectations. And the bar is higher, right? Because cash is earning 5%, and so investors need a good return to get out of that.
Yeah, I think that's still particularly painful for a lot of the active managers out there. You can get a pretty decent return still on cash. But let's talk a little bit about the sell-off we've been seeing. Of course, you mentioned yields. They have just been skyrocketing, it feels like, in the past few weeks. Do you see that as the driving force of the volatility that we're seeing in the equity market?
Yes, although I'd say 80% that, 20% some of the geopolitical tensions that we've seen. Obviously, that creates more uncertainty. And we've had a little bit of earnings come out so far in the tech space. And you've got this sort of conundrum of expectations from investors being kind of high. And then I think you've got, because of the geopolitical issues that we've had, some more cautiousness from management. And that combination is a little bit tougher, I think, for investors to stand and watch.
And given that, I mean, the majority of the sell-off has been driven by fears in the bond market, what's going on with rates and how high they are. Even if we get really strong earnings, is that enough to rescue the rally? How are those two dynamics going to play out?
Yeah, I think it's tougher. I mean, the market's, at the end of the day, is going to be driven by earnings. And if earnings can continue to outperform higher expectations, which I think earnings expectations for the full year are still a little high, of course, we can have that. But, there may have to be some cost cutting come in, and that's where I think the connection to the economy comes in, because if there is cost cutting, you might see a pullback in the job market, and then you really do get to have the Fed cut, because the Fed wants to cut. They just, the economic data, the broad economic data hasn't been supporting that. And I think it's because of a lot of the fiscal stimulus that's been out there.
Yeah, you do get that sense that this is a Federal Reserve that wants to cut rates. Whether or not it should, of course, is the big debate right now. But you have a really unique seat, of course, at Robinhood. You have a lot of visibility on what people are actually doing on the platform. So what have you seen among the retail investors on Robinhood over this 3-week-long sell-off?
Well, we definitely see our customers keeping a part of their money in cash, like, for sure. We offer good rates, just like a lot of places out there. But when it comes to investing, we actually see a lot of our customers, they add to things that go down, and then they trim some things that go up. So, for example, Tesla's been having a rough run, and they have been adding to those positions. And then you've seen, things that have been doing a little bit better more recently, and they've been cutting those positions. And that's really no different than, kind of long-term investors tend to do.